Investing early is one of the best options if you want to have a comfortable retirement, no matter how far off it seems. While you are still in your 20s or 30s, you need a significant amount of wealth to live comfortably. And for the working class in particular, investing their money is one of the best ways to achieve this. You see, if you start investing early, you will be much wealthier. Here's a great illustration. Assume you decide to start investing $500 each month and achieve an investment return of 8%. If you begin saving at age 25 and stick with it until you're 60, you'll have $2.16 million when you retire. But if you began investing at age 40 rather than 25, you would only have $341,000 at that point. Of course, this straightforward illustration is nothing new, and it depends on an investment earning an annual return of 8% compounded without accounting for inflation. However, as I've already stated, this is nothing new, and I'm sure you've heard it before. However, for the vast majority of people, this continues to be the best way to increase wealth and make sure you have a sizable reserve to use during hard times. In other words, you set yourself up for success by getting started early. We'll be looking at some of the most significant investments and assets you can make while you're young in today's Practical Wisdom video. But before we get deeper, if you are new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So, without further ado, let's get started. Number 1. Index funds. One of the best investments you can make before the age of 40 is stocks. Despite the potentially very high risk, they offer some of the highest returns. You have plenty of time to make and learn from mistakes as you begin your investment journey, but you should always make wise, considered decisions. Based on the S&P 500 index as the benchmark, stocks have an average return of 10%. In actuality, not many investments will offer a return rate this high. Bonds may be a good addition as you assemble your index fund portfolio. Bonds are the safest investment, even though they have the lowest return rate. You must make sure that the weighted bonds make up between 10 and 20% of your portfolio. Your investment is more secure as a result. You could also include the percentage and change it by your level of risk tolerance. Index funds for cryptocurrencies were just introduced. They appear to be quite promising, even though they have not yet undergone thorough testing. Their current return rates, which are between 10 and 15%, are very high. However, the risk rises as the return rate does. The fact that index funds charge little in fees is a big plus. The returns increase as the fees decrease. Beyond diversification, index funds also offer the benefit of many having low fees. Investment fees should be avoided as much as possible because they will quickly lower your returns. Be sure to consider the tax ramifications as you purchase the index funds. Number 2. Real estate. With real estate, you rarely make a mistake. One of the best investments in real estate for a variety of reasons. First off, there is typically a housing shortage, and real estate assets almost always increase in value. Owning a home is the first step in real estate investing. Your costs, such as rent, go down when you own a home. After purchasing your own home, you might consider developing additional commercial properties. This could be apartment buildings, townhomes, commercial buildings, and other real estates. There are other options though. If you're unable to invest directly in the real estate market, there are several crowdfunding websites where you can put as little as $500 into an investment. The money would then be invested in real estate properties along with the contributions of other investors. REITs are the names for these investments, real estate investment trusts. Number 3. Education. According to statistics, studying is most effective in your 20s. Your 20s and early 30s are the best ages for learning new things, according to research. Consequently, now might be the ideal time to earn that additional degree. Education is crucial because it can position you for success in the workplace. You must realize, though, that not all education and learning are advantages. Be cautious as you go because some learning can be classified as a hobby and is probably not monetizable. Start by looking for successful careers in your familiar fields if you want to invest in your education. Additionally, now might be the ideal time to raise your level of financial literacy. Number 4. Startup business. While you're still young, put money into a startup company. Why? The benefits of owning a business are endless. You will be able to make as much money as you can. A startup business is another investment you should make in your 20s that has an unlimited return on investment. The potential for massive ROI is outstanding. Even if it isn't the next Amazon, investing in a young company can have amazing returns. You don't necessarily have to launch the company yourself. You can make investments in others' companies in return for equity in those companies. For instance, if you know the founder, becoming an angel investor is a fantastic option. Your investment may take the form of a convertible note, which means that if a certain condition is satisfied, it may become a loan. The alternative is via crowdfunding. Numerous crowdfunding platforms feature amazing startups with great potential. Make sure you thoroughly research the founder and comprehend the company's history before investing in a business. Choose businesses with compelling narratives and founders who have some level of business-related training, experience, or education. The alternative involves collaborating with a venture capital fund. You can start by becoming an accredited investor and work your way up to venture capital. These funds, however, have strict requirements and a minimum investment requirement. Number 5. Treasury bills. For every investor, regardless of age, treasury bills are an essential investment. There is no better time than when you are young to invest regularly in treasury bills. Short-term government-guaranteed debt instruments called treasury bills are used to fund spending and manage the money supply. 3 tenors, 90 days, 182 days, and 364 days are available for treasury bills. Whether it's tuition, rent, or even professional exams, everyone has expenses to cover. The cash you have on hand can be easily invested in treasury bills and cashed out when the bills are due. This falls under the financial idea of matching assets and liabilities, which entails buying an asset to help pay for the settlement of an upcoming liability. Treasury bills are completely risk-free, so unlike other investment options, your returns are guaranteed. Why not invest in them since they have reasonable returns as well? Number 6. Growth stocks and dividend stocks. We've made it abundantly clear that taking risk when you're in your 20s and 30s is advantageous because you still have time to recover if you lose your money at this point. Therefore, investing in stocks provides a great way to invest some of your money in a high-risk, high-reward business. Growth stocks are simply securities with projected annual growth rates that are substantially higher than the industry average. In comparison to their peers, these stocks produce more stable positive cash flows and revenues. Contrarily, dividend stocks are typically those of mature, financially sound businesses, so their share prices are less erratic than those of growth stocks. You should start including dividend stocks in your portfolio as soon as possible. If the businesses continue to perform well, they offer chances to earn a consistent income over an extended period. Number 7. Exchange traded funds. Let's now take a closer look at ETFs, which are remarkably similar to the index funds we previously discussed. ETFs resemble index funds because they are collections of securities that include a variety of assets, including stocks, bonds, and gold. They trade similarly to stocks, so shareholders can buy and sell shares on the market. They are useful tools for investing in broad market indices like the S&P 500, in industries like technology or health, or even in niche markets like social media or robotics due to their versatility. The Schwab US Large Cap ETF, Global X Robotics and Artificial Intelligence ETF, and iShares Global Clean Energy ETF are a few examples of ETFs. Number 8. Commodities. A commodity is a term used in economics to refer to an economic good, typically a resource that is fully or substantially fungible, meaning that the market treats instances of the good as equivalent or nearly equivalent regardless of who produced them. You can invest in this in a variety of ways. The first is to invest in various quantities of physical raw materials like bullion made of precious metals. Additionally, investors can make investments using future contracts or exchange-traded products, or ETPs, that closely tracks a particular commodity index. These complex and highly volatile investments are typically only advised for experienced investors. Mutual funds that invest in companies involved in the commodity industry are another way to expose oneself to commodities. For instance, an oil and gas fund would hold stocks from businesses engaged in energy exploration, refining, distribution, and storage. Commodity investing has benefits such as portfolio diversification, potential returns, and an inflation hedge. Commodities have also performed the best during periods of inflation, making them one of the best assets to own. Number 9. Annuities. In a contract known as an annuity, you and an insurance provider agree that the latter will give you regular payments, either now or in the future. Either a single payment or a series of payments known as premiums is used to purchase an annuity. Some retirement savings opportunities are offered by annuity contracts. Your savings could be used by others to generate a retirement income stream. Others still practice both. You have a deferred annuity if you use an annuity as a savings vehicle and the insurance company postpones your payout to the future. On the other hand, you have an immediate annuity if you use the annuity to establish a source of retirement income and your payments begin right away. Fixed and variable annuities are the two most popular types. A hybrid product called an index annuity, also known as an equity index annuity or a fixed index annuity, is also available. Understanding annuities is important because they are frequently products that investors think about when preparing for retirement. Additionally, they are frequently promoted as tax-deferred savings products. Annuities do, however, have a variety of costs and fees, including administrative, mortality, and expense risk fees. Additionally, commissions on annuities can be very high, up to 7%. Number 10. Cryptocurrencies and initial coin offerings. Only recently have traditional Main Street investors begun to show interest in cryptocurrencies and initial coin offerings, or ICOs. Nevertheless, investors are drawn to these quickly shifting markets because of the billions of dollars raised in ICO financing and the over 1,000 different cryptocurrencies that are currently available. Most individual investors find it challenging to understand these complicated investment products and assess their risk levels. We do, however, know that they have extraordinarily high returns. The returns could be anywhere between 12% and 200%. Some ICOs have had exceptional success. For instance, the OTA had a 13,000 times return on investment. In other words, if you had invested $1 when it was offered, you would have made $13,000. And that's it for today. Thanks for watching. If you're new to this channel, make sure to subscribe and hit the notification bell button to get updated on our latest videos. Don't forget to like this video and drop a comment. See you next time.